All right, the agenda today is first, I want to try and put today's financial markets into historical perspective, kind of give you some ideas as to what we've seen in the past when we've had difficult markets. I know that the speed at which this market fell has been much faster than we've seen in the past, but we should still be able to draw hopefully some parallels from the past. Then after that, talk a little bit about why understanding your financial goals matter even more during times like this. Talk a little bit about a tool that I use that those of you that already work with me should be somewhat familiar with. Then I'm going to share some lessons that we've learned over the last few weeks. And then at the end, I will open it up for any questions that anybody has. So the first question that comes up when something like this happens is, how long will it last? It's also one that's not easy to answer. Some of you know that I tell a story that, about when I was an oil and gas analyst and I was charged to forecast oil prices, and I would be asked what my forecast was, and I said, well, part of my job is to forecast the price. So I'm going to give you a number as to what I think that price might be. But there's probably one thing that I can tell you when we're done. There's one number it's not going to be, and that's whatever number I tell you, because it's just too hard. My biggest concern as an advisor right now is really my clients' well-being. I care about my clients. I don't want to see them worrying or afraid. I'm fans of my clients. We're in this together. I'm here to help. One of the things that I've been comforted by is the fact that I haven't gotten a lot of questions or calls of concern during this, because hopefully we've had conversations up front that have helped to prepare us for the fact that things like this can happen. Let me go to the next slide, because I think that does a little bit better job of showing you the history of US bull and bear markets on average. Bear markets have lasted 14 months in the period since World War II. Market corrections have lasted an average of 5 months. And just to tell you the distinction, a correction is normally when the market falls 10%. A bear market is considered to be a 20% decline. So right now, at the peak of this decline, we went down almost 35%. We've come back a little bit more strongly over the last couple of weeks, and I believe as of yesterday, we were down about 19% overall, and we're up again today with the announcement of additional stimulus. But this chart just kind of shows you the duration of the bull and bear markets. So you can see the bull markets are the blue, and they've lasted much longer than the bear markets. Now, your long-term goals shouldn't have really changed in the last month, and we shouldn't change them today just because of what the market's done. The market's always going to change. The idea here is to keep your eyes on the prize. I like this image that's here because think about it, when we see those lanes for a running race, we think it's something that's short, but as you see those lanes extend way off into the distance. And that's kind of like how we have to look at things as investors and savers. We're really looking at the long term and not the short. So this is the roadmap that I use to help put together a financial plan, to help prepare for what's coming. And one of the most important things that you'll look at on this roadmap right now is the risk tolerance. What level of risk am I willing to accept? So a portfolio should be structured so that when you do have big market dislocations, you're not reacting out of fear, and you're more comforted to know that what you have in place should help you get from that point A, which is retirement uncertainty on this chart, to point B, which is where you have a more informed retirement. There can certainly be bumps in the roads like we have right now, but having a roadmap where we kind of know what the goals are, we know what we're trying to achieve, we have a plan to check in and make sure that we're doing what we need to do to get there. Having that in place can really help get through things like this. So now I'm going to talk about the 14 lessons that I think we've learned, over, at least I know I've learned, and some of these I've shared in some of the blogs and the other commentaries that I put out since this all started. So I think one of the first things is for all of us, is to stay safe and stay healthy. I mean, it's really important because we're not just taking care of ourselves. I mean, it's somebody like me, you know, I feel like I'm in a position to help others. So that makes it even more important that I stay safe and healthy so that I can take care of my clients and be there. They're not just for clients, but you know, if you I've said this in some of my blogs too, if you know anybody that isn't working with an advisor or their advisor has gone silent, please feel free to have them reach out to me. I'd be happy to talk to them and see how I might be able to help. The next thing to remember is the stock market does not move in a straight line. We have a bear market about every 27 months, so 6.25 years. The last one before this was about 12 years ago, so we were probably overdue. Every time we've had a bad market in the past, it's always come back. The only exception to that I can even think of is Japan, where, you know, their market peaked in the 80s and it's never really gotten back to those levels. But the US market has always come back. So remain focused on the strong term, on the long term, not the short. Your plan should help make you feel prepared. Companies aren't worth 30 to 40% less. And so, you know, if you look at what's happened in this, I mean, a good example is a company like Disney. I know Disney's been hit by what's going on because the parks are closed. There's not live sports, so ESPN isn't drawing the same ratings that it normally draws. That stock, before all this happened, it peaked at around $150. At the worst of this, it fell down to about $80. It's currently trading around $100. You know, I can't imagine that the value of, unless you just think that Disney was so overvalued before this started, it's hard to believe that the value of Disney's business over the long term has been hurt that much by what we've seen. And there's plenty of other companies like that. I just picked Disney because it's a really well-known company. And then just to remind you about how stocks don't move in a straight line, you know, this is a long-term chart that goes back to 1985. And you can see that we had a really big drop in 1987. Over time, that doesn't look like much. You know, the decline that we see now, it looks more, it looks bigger, but part of that's just because the numbers that we have right now are bigger. You know, at a S&P at 3,000, a 300-point move in the S&P is only 10%. And when when the S&P fell in 1987, it fell over 20% in a day in October of 87. But that, in terms of magnitude, that move wasn't anywhere near what a 10% move would be today. And one thing that I always like to think about is if you're saving for retirement, you're expressing a belief that the market's going to move higher over the long term, right? Because if you don't have that belief, then there's really no point in putting money into an asset that you think is going to decline in value. So don't let what happens now lead you to take actions that you might regret later on. So when you think about the money that you do have, remember that your safe money is your first line of defense. That's why we do asset allocation. So asset allocation is meant to provide a balance so that so that your whole portfolio doesn't all move together, so that some things are more or less volatile than others. If you have some near-term needs, you can use your non-stock investments to cover short-term goals and reduce volatility. Don't have all your money in the stock market. Some should be set aside to protect you and help you avoid doing one of the worst things we can do as investors, which is sell low. So like one of the things that I talk about in particular with those that are in retirement is think about how much money that you need to meet your expenses. Like take your Social Security and take any pensions and anything like that you have that are fixed income. Look at what that amount is. Then compare that amount to what your fixed expenses are. And then figure out how much you need beyond that. And if I look at the fact that over the last several decades, the market's come back within 24 months, think about having maybe about 24 months of your money in something that's really safe, that shouldn't be that volatile, to protect you and get you through this period to help you avoid the need to sell low. If you do need cash, I shared this in my blog this week. The 10 sources of emergency cash rank from best to worst. So the first one is if you have an emergency fund, that should be the first place you look. If your taxable account includes short-term securities, again, those shouldn't have been affected as much by what's gone on in the market. So those are good sources to look. be careful about taking money from your retirement plans. I mean, I know that the stimulus plan that was passed on the 27th, it included a provision allowing you to take hardship withdrawals from your IRA or 401k. You are allowed to put that money back, but just be careful, because if that money's invested in the market, it can be you could be in a really difficult position, because you're going to have to sell something at a low price, and then when you are able to replace it, if you are, you're going to have to pay more to do that later on, to put it back, because you're not going to be able, if you sell 100 shares of a stock and then it goes up 20%, you're not going to be able to replace it with the same 100 shares. You're going to be only able to replace it with, let's say, 80 shares. And so this little chart, it's from Carl Richards, who writes a column in the New York Times. He's famous for his napkin sketches, they're called. That's what he really does. And so, this is what we tend to do, and what we want to avoid is that when things are going well, we get greedy and we want to buy, and when things are going poorly, we get afraid and we want to sell. And so, as he says, if you keep repeating that, you're going to go broke. But anyway, this article that I referenced down here. Check it out, because it does a good job of explaining why those things are in the order that they are as well. The next thing is to remember that you're still on track you should still be on track to achieve your most important goals. When you have a financial plan, it's stress tested. There's Monte Carlo analysis, which looks at a lot of different scenarios. If we apply today's value, you might be a little bit behind where you thought you might be right now, but it's more than likely that you're still on track and you're still okay. Maybe it means there's a little bit less to leave to the kids. Even with the market being off, you should still be able to achieve your long-term goals. This is not the right time to revisit your understanding of risk. If you're feeling over anxious, once we get to the other side of this, that's the time to revisit your risk parameters. For most people, the number one concern is financial security. So what do you need to do today to feel that sense of security? Today probably isn't the right time to adjust your allocation. It could be a good time to rebalance or upgrade your portfolio. We'll talk a little bit more about those things later on. But let's take a different example. Assume you owned a beach house. You invested in it. You enjoyed it for a while. Then there was a hurricane. The house is underwater. Probably not going to sell then. You might think about it after you've fixed it and after the damage from the hurricane has been replaced. Then you might decide, do I still want to own this? But it's not the time to decide to sell it while this is going on and market price and the market value is depressed. You want to think about doing it afterwards. So you might think about making that decision now, but that's really not what you want to do. Next thing is, especially if you're in a position where you're adding money to the market, a falling market can be your friend. You should keep adding. If you have a 401k or a retirement plan at work that you can add money to, continue to do it as long as you can. I mean, obviously, if you have other needs, because some people have lost their jobs, and I know that's terrible, the number of people that have lost their jobs over the past few weeks, and the number of businesses have been shut down. So if you're in a position, not in a position to, then I understand if you're not adding. But if you are still working and you do have enough money to make ends meet and you can put money into your account, continue to do it. Take advantage of dollar cost averaging. Think about what happens if you're adding only $500 a paycheck. If the asset that you're buying is valued at $50, you buy 10 shares. Now assume it falls to 40. You're going to buy 12 and a half shares for that same $500. When the asset recovers its value and gets back to 50, your shares purchased at $40 are now worth $625 because it's 50 times 12.5. The ones you purchased at 50 are only back to even. And this next chart really shows the advantage of that. This looked at the impact of adding $100 to the S&P 500 each month starting in 2007. The nice thing about this, I mean, you can see in the chart that money added, that's probably March of 2009 is the peak. That returned over 4 times going into 2020. But by dollar cost averaging, there's lots of other times that you took advantage of the low prices. So it forces you to not have to try and pick the bottom. Just be comfortable that as long as you believe that the market's going to come back, if you keep adding, it's going to work to your advantage over the long term. Rebalance with discipline, avoid reacting with emotion. I've gone through many client portfolios and rebalance. it's important to stick to a process. You don't want to let emotion get in the way. Have your process and stick to it. You know, think about it, you can draw a grid and you have 4 different outcomes. You can have good process, good outcome, right? And that means that you're doing things the right way. You can have a good process and a bad outcome, and that's kind of bad luck. You can have a bad process and a good outcome. That's the other kind of luck. That's dumb luck, right? You got fortune. You have a bad process and a bad outcome, and that's where if you have a bad outcome, it's kind of justified because your process was bad. So like I think about it, my rule for rebalancing is if we have a 70% stock and a 30% fixed income portfolio, we rebalance that portfolio when it's at 65% stocks or when it's at 75% stocks. We get back to what our target is. Always remember, it's important to be on the lookout for new opportunities. So I mentioned, I touched on this before. I mean, think about in this kind of environment, you might have opportunities to harvest tax losses. So, if you have a fund, an ETF or a stock that's at a loss, you can sell it. You can replace it with something else. You can't buy that back, the same one back for 30 days because there's wash sale rules that prohibit you from buying and selling this, taking a loss and then buying something right back. But you can recognize some losses, buy an equivalent type of security, and then you'll get a tax benefit. If you have RMDs and you generally reinvest the proceeds, think about a Roth conversion. If your tax rate is at a point where it's low, it's another reason to think about a Roth conversion, because think about it. Again, if you had an asset that was worth $10,000 a month ago, it's now worth $8,000. Well, if you do a Roth conversion, you're going to pay tax on an $8,000, but you're not going to pay tax on the growth that gets it from 8 to 10, and you're not going to pay tax on the future growth that you would if you pulled it out of a regular IRA or 401k. If you're in position to do so, I've had several clients that have done this. You can make contributions to your retirement accounts, your 529 accounts. Think about doing it now instead of later. Again, you have the opportunity to buy an asset at a cheaper price today than you might in the future. Consider upgrading your portfolio. I have some clients for whom I manage individual stocks only. And so we've gone through and looked to see some of the securities that don't make sense, or the things that are just been hurt worse by what's going on in the market, where some things actually, there are a couple of stocks that I can find that have done really well in this environment. One would be Zoom. If those things are overpriced at this point, might be another opportunity to upgrade your portfolio by replacing an overpriced asset with a more attractively valued asset, or just a company that's a bigger risk with a company that's less risk. It's also important especially at a time like this, to know how all of your assets are invested. I've talked about the fact that when you have a portfolio, I understand there's people that don't necessarily want to have one person manage everything. That can make perfect sense because you have different people have a little bit different approaches and things like that. But it is important to have somebody that understands everything that you own and can look at everything that you own and make sure that you've taken the right approach across your portfolio. So that's also important to think about at this time. As I said earlier, if you're investing, then that's showing an implicit belief that you believe in the future, that this isn't going to last forever. Our strategy works as long as we believe in prosperity. And I really like this quote: "The man who's timid and hesitating, who stops to listen to his fears, lets many a good opportunity pass beyond his reach." That's why I'm saying, this is not the time to the market, or to, that's the other question, should I get more conservative? It's probably not the best time to do that. Again, that's the kind of thing that I talked about earlier. In the future, when this is over, then you might say, well, that was a little bit more than I could handle, or looking at where I am in life, I want to make sure that my future is a little bit more protected. So then I might want to change my allocation, but not now. And then this is just to show you. So if we look at the various times through history, we've had market bottoms. So this doesn't reflect right now because we don't know what the bottom. We don't know for sure that I mentioned that we were down about 35% at the peak. We don't know for sure that that's as low as this market's going to get. A lot of the things that I've read say it wouldn't be surprising to see us retest the lows, because that's kind of what happens. You know, the market goes down on fears, and then, you know, some good news comes out and people start to feel a little bit better, but then it may not be as good as they thought, or we haven't seen the full implications of everything yet. I mean, we haven't heard what first quarter earnings are, and this is going to be second quarter earnings too. So, you know, most companies have withdrawn guidance because they don't really know what their earnings are going to be. It's even harder than usual to forecast. But if we look at this, in the 3 months going into a market bottom, the average of all these periods, the market fell 20.5%. In the 3 months that followed, the market was up almost 25%. And in the 6 months that followed, the market was up almost 30%. And again, I know that we can't necessarily predict the bottom, but it's just showing that I mean, to me, it's just further evidence of the value of trying to stay invested and keep invested to the cycle. Because the worst thing is, think about it, if you pulled out at the point of your worst fear, then you have to decide when to get back in. And it can be just as hard to, if not harder, to decide when to get back in after you made that decision. And you could miss a big piece of those gains that we see put on these charts. And then this is looking at forward returns following history's worst bear markets. So if you look here, you know, at the worst trough that we ever had was in 1929, when the market fell 86%. You know, even back in 2007, you know, the market fell almost 57% from its highs. But, you know, I mean, from its lows, sorry. But 1 year out, 3 years out, and 5 years out, look at the returns that you had. So again, that shows some of the dangers of pulling your money out, and then what are you going to do in terms of getting back in, and are you going to miss a lot of these gains? I mean, there's people that you can find people that going back to the 2009 timeframe, they got so scared and they never got it back in the market. Look at the gains that they missed. Just remember too, stress is worse than short-term volatility. I mean, there's a lot of stress. It's virtually impossible for everyone to withstand the current volatility in the market. Stress is probably doing more damage to us than the short-term impact of changes in the value of our investments. So it's important to do what you can to help relieve the stress. I know for me, I view this time right now as on the positive side. You know, I have my whole family with me, and I feel like I'm blessed to have my 4 kids with me and my wife here, because I don't know that we'll ever have a time again where all of us are going to be together for this amount of time. And yeah, it's hard because we're not really going anyplace, but we're finding things to do together. You know, we're watching we're streaming some things on TV. We're doing some puzzles. We're playing some games. You know, last Sunday I went for a ride with a bike ride with my son, one of my sons. All those things, I mean, those can help to reduce the stress. You know, it's important to, we all get to decide how we feel about things. Fear and worry don't help. Choose to be happy. It's better for you and those around you if you can project happiness. You can be a better leader for others around you, be stronger. We get to choose the way we're feeling. So it's better to protect happiness than to feel sad and to feel stressed and to feel worried. One of the big things too, I mean, I say this many times, avoid the talking heads and the doomsayers. I've been one. And so I know what it's like to be one of those people. But you know, when you turn on CNBC or any news show, they're getting paid to make you worry. Most of those people don't really take the time to truly decide if they believe what they're saying. Making you worry makes you watch more. The more you watch, the better the ratings are. So turn off the financial news. Turn off the news about what's going on with the virus too, if you can. Because yeah, you have to pay attention to like the things that we're supposed to do. You know, like we're not supposed to go out unless it's an emergency. And those type of things you do need to know about. But a lot of the doom and gloom type stuff, if you pay too much attention to that, you know, it's only going to add to your stress level. It's only going to make it harder to get through this. Like I said, those people are paid to, you know, when you got a guy on CNBC yelling, sell, 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 you know, that gets your dander up and it makes you want to do things. And if you follow up through with that and let your emotions get in the way, you're most likely going to regret it in the end. So another thing to reduce stress is maintain or improve your exercise and fitness routines. If you have a healthy mind and a healthy body, it makes your isolation and separation that we're going through right now easier to handle. I'll tell you that the worst day that I had over the last month was the one weekday in this period that I missed my morning exercise routine. I had a lot to do one morning. I said, I don't need to get on the elliptical today. And I was so miserable that day. I make sure that I get up every morning now, not on the weekends always, but during the week, I get up every single morning and I got on the elliptical for an hour, get my exercise in, and it really helps my attitude. And it helps my, my overall, how my body feels a lot. And it helps to reduce the impact that this stress that this is having on me. And then the last thing is offer help. It's really important. Love is the greatest currency we have. If your goal is to be supportive to the people you love, then think about what you can do to make that happen. You can be a better listener. You can offer to help your clients, your family, your friends, your colleagues. What can you do in your local community to help? Can you go shopping for a neighbor, especially if they're elderly and they really shouldn't be, their risk and danger is greater than those that are younger. So can you help them out? Get together with family and friends virtually. I'll tell you that, like last night, so for me, it was the start of Passover last night. And so we used Zoom last night, and my wife has 3 siblings, and her 3 siblings and their families and one of her cousins, we all did our Seder together on Zoom. So we were still together. We went through the Seder, and then we had conversation just like we would if we were together. It's not as nice as being with everybody, but it does help. All right, so now I'm going to open this up so that I can take any questions that you might have. Hold on one second. Okay, so if anybody has any questions, I'm more than happy to answer them. I've unmuted everybody.
Well, this is different than like the 87 crash, etc., because this is not financial, it's health. Does that make any difference in your analysis?
So we've had health crises too, so yes, it's definitely different than what we had in 1987. There's certainly an unexpected. I mean, the worst pandemic that we had was way back in 1918 when we had the Spanish flu.
But in 1918, nobody invested, except unless you had a lot of money, you didn't invest in the stock market.
Yes, I mean, it was certainly a different environment, and there was a world war going on. So, I mean, to me, the biggest difference that we have here is the impact on the economy. I mean, even if you look at 2007 and 2008, that was different too, because that really hit the housing sector and the financial sector the worst. Here, it's a lot of small businesses, employment. We've had many more people lose jobs, but I still haven't come across anything that would lead me to believe that what we're going through right now is not something that we're going to come out of on the other side.
Okay.
Any other questions?
Philip.
Yeah, I got one. What's your thoughts on that 2.1? Was it 2.3 trillion they just put in? The Fed just, eradicated for all the. They said junk bonds, HYG, and municipal bonds. Could you elaborate on that? So,
I just saw that before this started, that they announced additional stimulus. I mean, I think that the government's doing all that they can to try to help people because so many people have lost their jobs. And then we have the other stimulus that so many people are going to receive money. There's all these loans that they're giving. I think it helps because I read that like the number of people that weren't able to pay their rent or their mortgage on May 1st, it was a pretty high number of people that didn't make those payments either. So they're really trying to do what they can to make to keep the economy going and to keep people going. I mean, the thing that I'll think about on the other side is, I mentioned earlier the idea of Roth conversions. And so one of the theories behind Roth conversions is to pay tax today because tax you're paying today could be less than it's in the future. And the one thing that I think about with all this stimulus is at some point we're going to have to pay for it. And the fact that we're going to have to pay for it, to me, the most common way to pay for it is through taxes. And with that, that to me makes Roth conversions more valuable. I will say, you mentioned junk bonds and things like that. I mean, I have tended to shy away from those, not just when this happened, but even going into this, just because I feel like the amount of the spread between the interest rates on high quality debt and what's perceived as lower quality debt, which is really what high yield bonds are, it's not that wide, and I don't feel like you're adequately compensated to take that risk. And those companies that are in the high yield category are probably the ones that are most likely to be hurt by this. So I would be a little bit careful there.
And then being you said earlier about you used to be the shot caller for the oil market. Are they got they said something about buying stocks on the secondary market? I mean, now I know the oil industry got hit hard. Are they thinking about buying that kind of stuff, or I mean, how would they determine which stocks to buy?
In the oil industry, so I mean, it's really hard right now because they don't even, there's oil that's being produced, they're running out of tankers to store it on.
Right.
I mean, so when I have a new client that I got, and we had to put some money in energy, and so I looked at companies that I thought were the really strong ones. I'd stay away from the companies. I think Whiting Petroleum was one that announced bankruptcy since it happened, and I would expect that the area that I want to be particularly cautious about would be the U.S. shale companies, because their cost of production's high. It's going to be hard for them to get their money back, even if they do produce oil. So I would look for the major oil companies that have the strong balance sheets, that have good balance, good management teams. Try to focus if I was looking in the oil sector. I would avoid it, but I would try to stay away from the riskier part of it.
I thought your comment on Disney was interesting, about Disney stock early on. Can you hear me?
Yes.
With social distancing, who knows who's going back to Disney with their family and all those large crowds. It's actually a very interesting variable in this whole crazy thing.
It is. I was reading earlier today, I didn't read the whole thing, but Bob Iger, who's the CEO of Disney, that he's going to be replaced in the near future because he's going to step down. He was saying that they're thinking a lot about this and how they're going to do it, and they're wondering if they're going to have like something like thermometers or something like that to test people before they go in the park, because they're aware that social distancing is still an issue. They would think they'd have to control flow of people into the parks a little, much more than capacity would be much less than it was before, at least initially, until we're on the other side of this. So yes, that can affect them, but I still don't think that a stock like that or a business like that has really been affected as much as the market's punished it. They still have other businesses too.
Yep. Thank you.
Sure.
In response to Eric's question, do you know what, can you hear me?
Yes.
Okay. Do you know what percentage of Disney's profits come from the parks and what percentage of it comes from their various broadcast and things? Their broadcast business should be going up substantially.
So I didn't know the numbers, John, and I don't recall them off the top of my head right now. I mean, some of the broadcast business is going to do all right. I'm sure Disney Plus is doing well, and Hulu, because that's also at least partially owned by Disney. The network TV, I would assume that that's doing reasonably well, but where they may be hurting is like ESPN. That part of the broadcast business I'm sure is not doing as well right now as it has, because there's no live sports. So I know so there's balancing things. I mean, and you also have to remember too, there's the movie business. And so what have they done with that? There's a couple movies that came out, I think like Onward or Outward, I forget which one it was, that came out right before this started. They went to be able to buy it, and now that's on Disney Plus. So, the revenue streams from some of those movies is going to be delayed, but then the big blockbuster movies, you assume that they're going to come out after all this, but all the parts of their business are affected. Again, I just don't think they're affected as much as you might see as you see in the stock price. And I do have to disclose, since I'm talking about Disney, that I own shares of Disney personally, and it isn't some client account. So I did have to make sure that I disclose that as well, since I'm talking about it. Does anybody else have any other questions?
I've got another.
Phil,
Yes.
in this type of uneven market, are you recommending individual stocks or your folks to stay more in mutual funds or something that's a little more broad, less targeted?
So I have two different groups of clients. I have some, for the vast majority of my clients, I just use ETFs, and I don't really use individual stocks, because I think that the broad exposure that ETFs bring, and I use ETFs over mutual funds because I think if they're in a taxable portfolio, they're more tax efficient. And from the underlying expense ratio that goes with the funds, I think ETFs are generally a little bit cheaper. So a broadly based, diversified portfolio, I think ETFs can make a lot of sense for most people. The people that have individual stocks are typically those that have larger portfolios, that there's more opportunities for tax loss harvesting, which was I talked about when you sell security and take a loss and then replace it with something else, and some flexibility, and they can have enough of a position in enough stocks to make sense. But for the vast majority of investors, I think a portfolio of ETFs is sufficient. Anybody else?
What kind of, what do you look for when you mentioned something about retesting the lows? I mean, I heard that too, but what do you look for when that's actually going down? I mean, we were down, like I was down, I know what, 30%, and now I'm at 20% down. And, if we break that low on the S&P, I mean, you have any type of forecast? You know what I mean? I don't know what you do. I mean, as far as, you used to do the oil, and you were able to predict price, but you have any idea with the overall market, or?
It's hard. I mean, I'm really just kind of making a guess if I say it. Like I said, I would not be surprised if we retested that low, and if we retest it, if you look like at 2017,
Wake up.
that's when we went below it, right? I felt going in when I was asked this question that the worst we would see would be a 30 to 40% drop in the market overall. So we at 35, we were in the middle of that range. I still haven't seen anything that would push me past that 30 to 40% range. I mean, it can't happen, but that's kind of how I think about it.
Especially with all this stimulus, it seems like they're really backstopping it,
That's right.
Your opinion, what do you think the various stimulus things will do to the inflation rate?
So I guess if I'm thinking about with low demand, I have to think that there's probably some inflation in some things. Like I know anecdotally, I haven't noticed it as much. Maybe I haven't looked as closely, but a lot of people have talked about the fact that when you do go to the grocery store, some of the prices are up right now. But the lower demand, I feel like at least initially, it's going to have a negative. There's not going to be inflation coming out of this because companies are accumulating. They probably have higher inventories. If you're a manufacturer of some type of product, I would expect that you have a little bit higher inventory, and people don't have as much available as a group. We don't have as much available cash flow. So I would think that would work to help limit inflation, at least in the near term.
Speaking of inventory, it's funny. I went to Sam's Club the other day, and everything's stocked, everything's put back in place, and they took all the limits off. You can buy what you want.
Oh, really?
Yeah, the panic's over.
It's interesting. I know too. It depends on what, because like even in this area, my wife was telling me that she has a coworker that lives in Westminster, and they had like no meat in the store that she went to, and they were missing a lot of other things. And I went in the Baltimore County area, I went shopping and I didn't have that issue.
Yeah, I'm in the Annapolis area.
Yeah, it varies from area to area, and like even if you go into a grocery store, I think there's less toilet paper and things like that. But if you go into the warehouse clubs, they do seem to have it. So I think part of it may be dependent upon where you're shopping and how their supply chain works, and how big a purchaser they are. And I'm wondering if some of those larger companies that have a national presence have more access to things than those that are smaller, because there's more.
Well, the social distancing. While I was watching the Loudmouth on the CNBC, and he was saying that it's going to kill like Costco and the warehouse to have only let X amount of people in the stores. But I'll tell you, I think that if you think it out a little bit, I think delivery is the way to go now. I mean, if that becomes a problem, that Instacart's really been a lifesaver for me.
Yeah, I mean, it's really interesting too, because I've just noticed I only go out once a week to go shopping, but when I've gone, I've noticed there's such a big difference from store to store. And I find like Costco, when I went into Costco and I felt that they were doing a really good job. And I've gone into other stores and I didn't feel like they were. So I think that also matters. Different places are going to different level of care to protect their employees and their customers. And to me, that affects my willingness to go to one place over another. With those delivery services, my wife has mentioned that too. It's just some things you can't get through the delivery services, and some of them you can call the store ahead and they'll put the goods together for you, and then you don't have to go in the store and they bring it to you.
Yeah.
Anybody else have any other questions that I can help with? All right, well, if there's no other questions, I did bring up on the screen, if anybody needs some time to talk or has any questions that they didn't want to ask here, or just any other general questions, there's the link to my calendar where you can schedule a 15-minute call. Appears on the screen, and you're welcome to go to my calendar and set up some time to talk. And I want to thank everybody for coming, and stay safe and healthy.
You too.
Thank you.
Okay, thanks.
Bye, everybody.
Thank you, Philip. Be well. Be well, everybody. Hey, Randy.
Be safe.
You too. Thank you.